India introduces higher GST on sin goods, tobacco, and pan masala to attract 40% tax from February 1st. The government of India has announced a major overhaul in the taxation of so-called sin goods, with higher goods and services tax, GST, rates and additional levies set to take effect from February 1st, 2026. Under the new structure, tobacco products, pan masala, cigarettes, and similar items will face significantly increased tax burdens, a move aimed at both discouraging harmful consumption and strengthening government revenues. What's changing? From February 1st, 2026, the government will implement a revised tax framework for sin goods. Historically, these products attracted GST plus a compensation cess, but the compensation cess is now being replaced by a new combination of GST and additional levies. Tobacco products, cigarettes, and pan masala will attract a 40% GST rate. Biddies, a popular low-cost smoking product, will continue to attract an 18% GST rate. In addition to GST, tobacco products will face an additional excise duty, while pan masala will be subject to a new health and national security cess. The old GST compensation cess, previously levied as part of the tax on these sin goods, will be discontinued. Why the change? According to the government's rationale, increasing taxes on products such as tobacco and pan masala serves multiple purposes. Public health. Higher taxes on sin goods are widely seen as an effective tool to discourage consumption of harmful products linked to diseases such as cancer and heart conditions. Revenue stability. With the GST compensation cess ending, the government is redesigning the tax mix to ensure continued revenue collection from these high-margin items. Regulatory oversight. The change allows for stronger monitoring and better compliance, especially in sectors like gutkha and chewing tobacco, where underreporting has been a concern. Impact on consumers and industry. Consumers can expect higher prices for cigarettes, tobacco products, and pan masala once the new tax structure takes effect. Because GST will be applied at a steep 40% rate, and additional levies will be added on top, the overall cost burden on these goods is set to increase. For manufacturers and distributors, the effects are already visible in financial markets. Shares of major tobacco companies, including ITC Limited and Godfrey Phillips India, experienced sharp declines following the announcement, reflecting investor concerns over higher tax pressure and possible reduction in sales volumes. Looking ahead, the tax changes represent a significant shift in India's approach to sin goods taxation as the compensation cess gives way to a long-term mix of GST and targeted levies. While aimed at improving public health and maintaining government revenues, both consumers and industry players are likely to feel the effects once the new regime comes into force next month. Governments often use fiscal policy as a tool to influence consumption patterns, and this latest revision underscores that strategy, sending a clear message about the country's priorities on health and governance as we move deeper into 2026.